The Fed Reserve just blew everyone away. You need to hear this. This is exactly the moment where most people freeze, hesitate, and talk themselves out of doing the one thing that actually makes money over full cycles. When Ethereum is down over 30% from its highs and Bitcoin is nearly 30% off as well, that's when narratives flip from excitement to fear, from confidence to confusion. So, what is actually going on here? Let's dive in right now. So I need you, the amazing viewers, kick back, get comfortable, smash the like and subscribe button. Now, let's get right into the video. And that's not accidental. Markets are designed to feel safest at the top and most dangerous near opportunity. People love buying when prices confirm their emotions, not when fundamentals quietly strengthen beneath the surface. That's why most participants only feel comfortable pressing buy when assets are already extended, already crowded, already priced for perfection. But real positioning happens when events are unfolding, not when they're resolved. That's the difference between reacting and anticipating. And right now, what's unfolding is far bigger than a red week or a scary headline. We're sitting at the intersection of macro policy shifts, institutional adoption, and structural supply dynamics that most investors aren't even tracking yet. Zoom out to what this week actually represents. You have one of the most consequential Federal Reserve meetings of the year landing right as crypto sentiment is stretched thin. A near certainty rate cut, deep internal disagreement inside the Fed, and a transition period where Jerome Powell is clearly approaching the end of his tenure. That combination matters, not because of the immediate candle reaction, but because it sets expectations for 2026. This isn't just another meeting. This is the Fed trying to thread the needle between signaling control and admitting reality. A 25 basis point cut sounds small, but it carries an enormous psychological message. It tells markets that restrictive policy has hit its limit. And when you combine that with visible dissents on both sides, what you're really seeing is fragmentation at the top of monetary authority. Markets don't like uncertainty, but assets that benefit from liquidity expansion quietly love it. Now let's talk about the pattern almost nobody wants to acknowledge because it feels uncomfortable. Bitcoin has climbed into nearly every FOMC meeting this year, chopped around the announcement, and then sold off after. September did it. October did it. The structure has repeated often enough that ignoring it becomes reckless. The market front runs the decision, prices uncertainty, then reacts to the nuance. That doesn't mean Bitcoin is weak. It means Bitcoin trades macro expectations aggressively. The overwhelming consensus of a rate cut is exactly why the immediate reaction can disappoint. When everyone agrees, there's no surprise left to bid. That's how markets work. And understanding that prevents emotional decisions when volatility hits right after what everyone knew was coming. But here's where people lose the plot. They confuse short-term reactions with long-term direction. Jerome Powell exiting and being replaced by a more pro-growth chair in 2026 changes the entire slope of policy expectations. Even the announcement of that transition matters. Forward guidance matters more than current rates. And a new Fed regime doesn't wait for perfection before loosening. It waits for justification. Inflation slowing, growth wobbling, and debt servicing pressure quietly building give them that justification. That's why being bullish long-term while cautious short-term isn't contradictory. It's disciplined. It's understanding that volatility is the toll you pay to position before structural shifts become obvious. Now let's talk about adoption, because this is where the disconnect between price and reality becomes extreme. Bitcoin is no longer just a speculative asset sitting on the fringes of finance. Entire regions of the world are openly treating it as a strategic component of their financial future. When sovereign players like the UAE publicly frame Bitcoin as a pillar of modern finance, that's not marketing, that's signaling. Governments don't signal unless they want capital flows to notice, and capital does notice. These moves don't show up immediately in spot price, but they show up in policy alignment, infrastructure investment, and long-term demand. That's how adoption actually happens. Quietly first, loudly later. At the same time, something critical is happening under the hood that almost no retail investor tracks consistently. Bitcoin supply is leaving exchanges at scale. Over 400,000 Bitcoin gone from exchanges in a single year. That's not a statistic. That's behavior. People do not remove assets from exchanges if they plan to sell them. They remove them when they intend to hold, custody, or deploy them elsewhere. A 2% reduction in total circulating supply available for immediate sale fundamentally alters future supply shocks. You can ignore it emotionally, but markets won't. Every historical cycle shows the same thing. Shrinking exchange balances tighten future volatility upward, not downward. And this is where Ethereum enters the conversation in a way most people still underestimate. Ethereum is no longer just a smart contract platform competing for mindshare. It has become the primary settlement layer for tokenized finance. Wall Street didn't choose Ethereum by accident. Tokenized stocks, real-world assets, and digital dollars are being built there first because liquidity, developer tooling, and regulatory familiarity converge there. Nearly $6 trillion in stablecoin volume in a single quarter isn't hype, it's usage. Ethereum quietly settling more dollar value than Visa and MasterCard combined isn't theoretical, it's measurable. And that reality changes how you evaluate drawdowns. Price weakness doesn't negate structural dominance. Solana deserves its own mention because throughput matters. On-chain transaction volume doesn't lie. When USDC activity concentrates on a single chain, it tells you where speed, cost, and user experience intersect. That doesn't make Solana a replacement for Ethereum. It makes it a complementary execution layer. Markets aren't winner-take-all at the base layer. They're modular. And understanding that modularity prevents tribal thinking that destroys portfolios. Now let's address the elephant that most analysts are only starting to whisper about: privacy. Bitcoin and Ethereum are transparent by design, and transparency has been a feature. But at scale, it becomes a limitation. Institutions, corporations, and even individuals do not want every transaction permanently visible. History shows that privacy always becomes valuable after adoption, not before it. That's why privacy narratives tend to arrive later in cycles, not early. And the recent explosive move in privacy-focused assets isn't random. It's a signal that the market is starting to price the next missing layer. Privacy infrastructure doesn't mean hiding wrongdoing. It means selective disclosure. Zero knowledge proofs, confidential transactions, and privacy bridges solve real problems for capital deployment. And protocols that can add privacy without sacrificing custody or liquidity are solving a problem traditional finance never figured out cleanly. When narratives shift from speculation to infrastructure gaps, that's when entire sectors reprice. Tokenization is accelerating this shift even further. With regulators closing investigations and green-lighting expansion, tokenized treasuries, equities, and collateral markets are moving from pilot to production. When the CFTC allows Bitcoin, Ethereum, and stablecoins to be used as collateral in derivatives markets, that's not symbolic. That's functional integration. It increases utility, velocity, and demand simultaneously. Assets that can be posted as collateral gain an entirely new dimension of value beyond price appreciation. This is why balance sheets suddenly matter more than slogans. Complicated structures amplify risk in volatile environments. Clean exposure to assets with real settlement demand becomes more attractive when leverage tightens. That's why you're hearing more voices openly say they're adding Ethereum at depressed levels while avoiding over-engineered proxies. Buying when assets are structurally improving but emotionally unpopular is how asymmetry is created. And finally, we come back to the Fed, because everything still runs through liquidity whether people like it or not. Quantitative tightening has effectively stopped. Debt buybacks are ramping. They won't call it QE, but functionally, that's what it becomes. Liquidity doesn't announce itself loudly at first. It seeps. It shows up in asset stabilization, then expansion. The people waiting for perfect clarity will miss the early phase. The people positioning now accept uncertainty in exchange for upside. This is not about predicting the next candle. It's about understanding where capital is flowing, what infrastructure is being built, and why fear clusters at exactly the wrong moments. Subscribe, stay informed, and most importantly, think in systems, not emotions. That's how you survive cycles and compound through them.